Hi everyone, it's AJ with North Capital Mortgage, and today we want to look at interest rate and APR. What is the difference between the two? Let's take a look. So, as a brief overview, today we want to understand what is an interest rate. Secondly, we want to understand what does APR stand for and what does it mean? What's the difference between the two, and how do we utilize our understanding of APR to make better decisions during the loan process? Let's take a quick look. So, what is an interest rate? The interest rate is the cost you pay annually to borrow money expressed as a percentage. Simple as that. It applies only to the principal loan amount and does not take into consideration fees used to acquire the loan. So, we can utilize this to calculate what our monthly payments will be. For an example, $200,000 loan, 6% interest rate. Pretty basic calculation. We know that 200,000 times 0.06, the interest rate expressed as a decimal, is $12,000. That's going to be your annual interest, or divide that by 2. You're going to have $1,000 a month of interest on this $200,000 loan at 6%. APR, we want to understand what APR is. Stands for annual percentage rate. APR represents the total borrowing cost annually, which includes interest rate and lender fees. It provides a more comprehensive view of the true cost of the loan. It will help borrowers compare loan offers more accurately. And the great thing about APR is whether you pay acquiring costs or loan fees out of pocket or whether you finance them into the loan, that APR is still going to consider those loan fees as part of the APR calculation. So let's take a look what fees are included in the APR. Generally, APR is going to include the cost directly tied to securing the loan, but not necessarily costs related to buying the property or maintaining it. So some examples of fees included loan origination points, discount points, your mortgage broker fees, mortgage interest, underwriting fee, processing fee, some fees that will be excluded: title insurance, appraisal, home inspection, escrow fees, property taxes, and homeowner insurance, because these fees are not tied to acquiring the loan for the property, okay? Let's look at the calculation here. There's a whole lot going on. Example, let's take a look at the specs. Loan amount $200,000, interest rate 6%, your term is 30 years, fees to acquire the loan $5,000, monthly payment on that is $11.99. And this calculation, just like you would if you're calculating what an amortized mortgage payment would be, you're not going to calculate that on your own. You're generally going to go to Google or a search engine and type in mortgage calculator. You're going to do the same here. Just type in APR calculator. As long as you have those specs underneath the example, you'll be able to plug those in. And I promise you, for this example, the resulting APR is 6.25. So we've got an interest rate of 6, and when we take into consideration loan acquiring costs, your APR is 6.25. So what does that tell us? And how can that help us? Let's take a look at some examples or some options here. So let's say you have a loan amount for option 1 of $200,000. Again, interest rate at 6%, and we know the APR on that example was 6.25. Option 2, $200,000 loan amount. Same loan amount, interest rate 5.75, but APR is 6.875. So if the APR is that much higher, you may be thinking, well, they probably paid a lot more in fees. But why is the loan amount the same? This may be because they did not finance those extra fees into the loan. They paid them out of pocket. And we're still going to take those fees, which are paid out of pocket, into consideration for APR calculation. And you can see here the spread on option 2 is about 1.125% difference from the rate to the APR. On option 1, it's only a 0.25 percentage point. So you're going to have to take a look at this one pretty closely. Take a look at the line item fees on your loan estimate. And my gut is going to tell me for the long term, option 1 is probably a better option for you, even though the interest rate is higher. Okay. So to sum it up, interest rate only includes the cost of borrowing, not cost to acquire the loan. APR includes interest rate plus fees to acquire the loan, and it's going to show you a much more complete cost in relation to shopping for a home loan. Expect your APR to be higher than the interest rate, and that's because loans aren't free. You're always going to have fees associated. You want to compare the APR not just the interest rate when shopping for a loan. The APR, just like in the previous example on the previous slide, it can help you to potentially uncover some hidden costs in a lot of the low interest rate offers that are available. And when you're looking at advertisements, remember, check the fine print, because people who advertise interest rates online or anywhere are required to not only put the interest rate, but the APR. So many a times I've had people say, AJ, you're offering us a 6% interest rate, but we're seeing that the same mortgages offered online for 5.5%. And I say, well, check the APR. And generally there's a pretty large spread. It's because they're likely having to pay quite a bit of buy down points to get to that rate, which may not really make sense. So I appreciate your time. I hope this was very helpful to you. If you have any questions on APR, please let me know, and stick around for the next couple videos, because we're going to go over loan estimates and show you how to identify line item fees for your mortgage. So thanks again. Hope you all have a wonderful day.